Execute a corporate action, buy a mutual fund, or allocate capital to alternative assets, and your transaction travels through a hidden digital nervous system. KFin Tech is the entity operating that network. They operate at a massive scale, currently holding a market capitalization of approximately 14,800 crore rupees. Looking at their footprint among corporate issuers, they command a 48.2% market share within the NSE 500. On the asset management side, KFin Tech controls the administration and record-keeping for 32.4% of all mutual fund assets under management in India. But classifying KFin Tech as a traditional financial firm is inaccurate. Their actual business model is Platform as a Service, or PaaS. They do not manage the money. They provide the proprietary tech infrastructure that allows asset managers to function. To support this ecosystem, their data centers house over 350 servers, processing more than 250 terabytes of highly sensitive, strictly regulated financial data. The sheer complexity of regulatory compliance, combined with the catastrophic risk of migrating this volume of data to a new provider, creates a near-impenetrable duopoly moat for KFin Tech and its main rival, CAMS. Asset management companies are effectively locked in. This chart breaks down exactly where KFin Tech's money comes from. Currently, 71% of total revenue is generated by their domestic mutual fund registrar and transfer agent services. However, the immediate growth catalysts are located in the smaller slices of this mix. They are aggressively expanding into alternate investment funds, and they currently operate as the second-largest central record-keeping agency for the National Pension Scheme. Management is relying on these segments to hit their aggressive FY26 guidance, which targets a 24% top-line growth rate. That 24% target is a stepping stone to a much larger stated objective, doubling total company revenue within the next 3 years. To hit that 3-year timeline, they are executing a strategic pivot away from purely domestic reliance, targeting a 70% year-over-year surge in international revenues. Their explicit demographic for this expansion consists of international asset managers holding over $100 million in assets under management. KFin Tech is actively transitioning from a domestic back-office provider to a global financial infrastructure platform, bypassing the natural growth limits of the Indian market. The FY26 numbers show this engine working efficiently. Top-line revenue increased 19.3% to 1,301.4 crore rupees. Core profit after tax followed that trajectory, growing by 6.2% over the same period. Looking at valuation multiples, KFin Tech trades at a trailing price-to-earnings ratio of 43.3, a forward PE of roughly 38, and a PEG ratio of 1.82. Those multiples are supported by highly efficient operations, characterized by a 40.7. This line chart tracks return on equity over multiple periods. Because they deploy an asset-light software model, KFin Tech operates with extreme capital efficiency, consistently holding an ROE between 31.5% and 35%. Their balance sheet reflects this efficiency perfectly. They generate strong free cash flow, carry functionally zero inventory days, and operate with virtually zero debt. Look at the shareholding pattern table. Notice the sharp drop in promoter holdings, falling aggressively from 49.1% to 33%. An exit this size typically crashes a stock. Instead, the supply was absorbed by foreign institutional investors, whose stake jumped to 24.6%. Institutional money recognized the pause model as a reliable compounding machine, providing demand to clear the promoter's shares without breaking the stock's momentum. Running a forensic check on the financials, the first potential flag is rising auditor fees. However, a deeper look confirms these fees are scaling linearly with KFin Tech's international expansion and client onboarding. There are no regulatory anomalies here. Next is the banking ratio trap. Traditional value investors often see KFin Tech's price-to-book ratio between 12 and 17 and immediately flag it as severely overvalued. This is a misclassification. A high price-to-book ratio is the standard baseline for asset-light software companies. Their value is in their proprietary code and client lock-in, not heavy physical capital. Retail investors often try to evaluate them using gross non-performing assets, net NPAs, and net interest margins. These metrics are completely inapplicable. KFin Tech does not lend money, they process data. Finally, there is the risk of customer concentration. KFin Tech relies heavily on its top 5 AMC clients for a large chunk of its revenue. If one leaves, revenue drops. But as we established, the extreme stickiness of their PaaS infrastructure makes that churn highly improbable. KFin Tech passes the forensic audit, The numbers prove it must be valued as a pure-play tech infrastructure SaaS company, not a risk-bearing bank. The latest Q4 and FY26 results validate the growth trajectory. Quarterly revenue hit 347.3 crore rupees, a 22.9% year-over-year increase. However, core PAT slipped marginally by 1.0%, down to 84.1 crore rupees. Management attributes this temporary margin pressure to their aggressive investments in international expansion. While the internal numbers are solid, there is a major external structural risk to the company: SEBI. SEBI has been forcing mutual funds to compress their total expense ratio, the fees they charge investors. When AMCs are forced to lower their fees, they pass that margin pressure directly down to their service providers. This means KFin Tech is facing a direct yield squeeze. Market projections show their mutual fund RTA yields compressing from 3.8 basis points down to 3.6 basis points. They are not the only ones affected. CAMS is dealing with the exact same regulatory headwind. But KFin Tech has a unique structural defense. Because their client portfolio is weighted heavily towards smaller mutual funds and high-yielding equity assets, they have a natural buffer that absorbs some of SEBI's mandated cuts. The central tension for this stock over the next 24 months is a race. Can KFintech's aggressive international expansion generate new revenue fast enough to outrun the yield compression dictated by domestic regulators? Looking at this chart, KFintech traded between 456 and 1,314 rupees over 52 weeks. Evaluating momentum, price action is testing the 20 and 50-day moving averages near 860 rupees. Below that sits the 150-day moving average, the critical line of institutional support. Now there are three clear paths forward. In the bear scenario, SEBI enforces deeper than expected TER cuts, and KFintech's international onboarding stalls out, causing margins to break below 35%. In the base scenario, management executes their plan, maintaining a 22 to 24% revenue compound annual growth rate while stabilizing EBITDA margins around 40%. In the bull scenario, their new global API KRA architecture and planned blockchain tokenization protocols gain rapid adoption, triggering massive margin expansion across borders. The valuation math is straightforward. Trading at a forward PE of roughly 38, KFintech's absolute earnings must effectively double over the next 5 years to justify a 15% annual return for new investors today. Management has explicitly guided that they intend to double revenue in just 3 years. Backed by relentless accumulation from foreign institutional investors, KFintech earns a clear buy rating for investors weathering regulatory noise to secure a monopoly-grade asset.